Hey, what's up, everyone? Welcome back to my world of stocks. Once again, we're getting a fresh wave of new SEC filings from the biggest institutional investors in the world, showing us which stocks they've been buying. And in today's video, we're covering the notorious BlackRock, the largest asset management company in the entire world that holds literally trillions of dollars in the market. So huge influence over it. And the interesting thing about this previous quarter, is that the market was actually falling pretty hard. In fact, the NASDAQ alone was down over 10%, which is a pretty big drop for just an index there, with many individual stocks falling much more. Some were even down like 30, 40%, even more than that. Some really were down big. But of course, during this time, the rich elites were out there scooping up shares at those lower prices, with BlackRock being no different, spending many billions of dollars last quarter. So in today's video, we're going to run through the 5 largest of those purchases. And as always, I'll give you my own opinion on each one of them, and I'll even rank them from best to worst too, based on that opinion. So let's not waste any time, guys, because I can't wait to run through all of these with you. Just please hit that like button if you do appreciate these videos. Really helps keep my channel alive, and it means a lot to me. So thank you for that support. But let's go ahead and jump into it here, and we'll be sorting these stocks from smallest to largest purchase based on estimated values during that time, during that quarter. So for example, the smallest purchase of the bunch was in the payments giant Visa, ticker symbol V, which BlackRock increased their position on by adding another $2.3 billion worth during the quarter, bringing their stake up to over $50 billion now. And yet that's only worth about 1% of their portfolio. That's how insanely large BlackRock is. Now, Visa, I do actually like this one a lot. In fact, I own the stock myself, as they essentially operate a duopoly with MasterCard around many different parts of the world, where apart from China's UnionPay, they actually control almost 40% of the world's digital payments transactions, and a whopping 61% of America's market share by purchase volume too. That's insane levels of dominance, obviously, and it's of course led to some really strong financials that break new record highs in most years. For example, just look at how crazy last year's numbers were, guys. So they did over $35 billion in sales, which was up a double-digit percent, by the way, despite them already being the clear market leader. And even crazier than that, they put up almost $20 billion of that. It went straight to the bottom line in pure net income. That's insane profitability. And not only was net income up 14% year over year, but guys, that's margins of around 55%. I mean, that's almost unheard of in the market. And it's really because their business is just so low cost. First of all, almost everyone uses cards and digital payments these days, especially with the rise of e-commerce, right? And so every time you make a purchase like that, even if it's just with like a debit card for your checking account, most of the time it's still using Visa's own network to process the transaction, which they're then able to collect fees on every single time. And of course, that's going to be, very high margin for them because it's all digital. Plus, they're even investing in new technologies to ensure future growth and prevent any disruption in their business too, like with crypto, for example, where they not only launched new crypto-linked cards, pretty crazy, it allows users to pay with crypto in places where Visa is accepted, and then Visa just kind of converts the money for you wherever this is allowed. But they've also invested into several blockchain and stablecoin platforms and other technologies too, including new investments they made in BVNK, which is a leading stablecoin infrastructure platform. I mean, they've had Visa Direct for a while now too, for instant transactions. There's a lot of cross-border features, and there's just a lot more that they've been working on, and that's actually been providing a lot of growth for them too. All of it, though, is just leading to a ton of success for the company as a whole, with them even crushing last quarter's earnings too. Once again, they typically always crush earnings, but this time they even announced another $30 billion of stock buybacks too, which is very high. So the company is just on fire by all accounts, and I also think that they have one of the best management teams out there that I've really observed. But unfortunately, that kind of performance has also led to a stock price that is very hard to get on any dips. It's almost always trading for record highs. And as I've told you guys many times before, the only real way to get in on a stock like Visa, you have to make sure that you buy in at even the smallest dips that you see with it. Whenever you're lucky enough to come across them, you got to take advantage of them. Now, as far as ranking it though, the valuation is pretty rich. It's usually trading around 100% more expensive than the sector on most metrics. So it's not an easy stock to kind of compare to most others with more kind of future potential at cheaper price points, right? However, I also believe that for that premium price that you pay for Visa, you get back a premium company in return. So I'm still ranking them pretty high here at number 2 for now until we see what else is on this list. All right, now moving on to purchase number 2, we actually have the only ETF of the list, and that's going to be in the iShares IVV ETF, which BlackRock added another $2.6 billion of in the quarter, bringing their stake up to over $40 billion in total. Now, I'm not really a big fan of this one though, because it is just essentially like buying the S&P 500. IVV is an ETF that is actually issued by BlackRock themselves through iShares, and it just tracks the broader S&P 500 index. So it's basically like betting that the market will go up over time, which to be fair is a very safe bet because the market does always climb higher long term. But it's going to be a little more boring than, say, if you were handpicking the stocks individually. And because of that, your gains will also be a bit limited to really just what the 500 of the biggest stocks in the market can do as a whole, which over the past decade, it's climbed around 166%. Again, that's totally fine if you want a more hands-off approach to investing. But just to give you some comparisons here, the same investment into even just some very obvious stocks to own like Google, Amazon, or Microsoft would have given you gains of 460%, almost 800%, and more than 830% respectively. So while there's nothing wrong with owning ETFs, especially ones that give you exposure to more obscure markets like international ETFs or even ones focused on specific metrics like dividends, but for this one, it's going to get the bottom ranking for me personally just because I enjoy handpicking my stocks individually instead, and I feel like I can get better returns there. All right, moving on to purchase number 3 though. Well, speaking of those other individual stocks that I just showed you, BlackRock actually purchased another $2.8 billion of the tech giant Microsoft, ticker symbol MSFT, bringing their stake up to over $218 billion worth in total. And that's still worth less than just 5% of the portfolio. That's incredible, right? Anyway, not much to say about Microsoft that I haven't already said in many other videos. It's personally my number 1 largest holding in my own portfolio for a reason. Microsoft is unbelievably large and dominant, especially on profits. And if you thought that Visa actually looked crazy, Microsoft is even crazier. Now, it's not as high of a margin as Visa, but just the sheer numbers are kind of mind-blowing with incredible margins too, some of the biggest in the world. Like last year, for example, they did a whopping $245 billion in revenue, which was somehow still up over 15% year over year, with a giant 88 billion of that going straight to the bottom line, and was up even more year over year at 22%, resulting in margins of over 35% too. I mean, guys, there's really, I would say, every company in the world, and then there's Microsoft above them at another level, because it's just so hard to match that kind of performance that Microsoft puts out, year after year. And of course, the reason why they're so profitable is because they're so big on software. So they carry software-like margins on a lot of their businesses like Windows, Office, Copilot, GitHub, LinkedIn, Xbox. All of those, by the way, have subscription services that keep billions of high margin dollars pouring in. And when it comes to the cloud with Azure, well, that's the most important of all, as the second largest in the world, which they've actually committed another $80 billion of investment into AI and data centers this year to make sure that they stay on top. And I think the only other company spending more than that is probably Amazon, which apart from them and maybe like Meta and Google, Nobody else even comes close to that kind of gigantic investment that they're doing. Now, because of that, though, the stock is pretty much always rising with a rich valuation because of that performance. So, very similar to Visa here in that sense, where if you want to own it, you'll have to just take every little dip that you come across, and then kind of hold it very long term to maximize your gains. At least that's what I've done myself. As far as ranking it, though, I'm sorry, Visa, but Microsoft has a special place in my heart, and they're going to get the #1 spot. Just too large, too dominant, too diversified, and still too much future potential to look forward to, especially with artificial intelligence. Unfortunately for Microsoft, though, I'm not sure they'll be able to hold on to that #1 ranking, because purchase number 4 is in the one company that is actually spending more than them on AI data centers, and that is the mighty Amazon, ticker symbol AMZN, who BlackRock added another $3 billion of in the quarter, bringing their stake up to $133 billion now worth in total. Now, don't get me wrong, both companies are amazing. It's also not really fair to even compare them because of all their differences too. Like the fact that Amazon also happens to be the biggest e-commerce giant in America, with no one else even coming close to their market share. And they're also the second largest globally, only surpassed by the Chinese giant Alibaba based on merchandise value. But besides that, Amazon is obviously the #1 largest in cloud computing too, which they just committed around $100 billion to expanding also, alongside other AI initiatives this year in total CapEx. And when looking at their financials, they're similarly large to Microsoft too, but with one key difference. And it's really in how they focus on profitability versus maybe growth. I mean, don't get me wrong, there's overlap here for sure. Both are excellent at both metrics, but there are just some differences in the amount of it. Like last year, for example, Microsoft did almost $30 billion more of net income. However, that was growth of 21%, which again is very, very strong. But Amazon was at a whopping 95%. Now, obviously, over time, that growth will come down for Amazon, but it just shows the massive potential that they have as they slowly start taking profitability more seriously. Like, for example, their margins were only less than 10% last year after doing well over $600 billion in sales. In other words, over time, and especially the more that their cloud and AI businesses grow, which will be much higher margin, obviously, than their e-commerce business, well, there is still going to be a lot of room for expansion on that bottom line. And yet, despite the stock always being a strong performer, a recent dip has actually left their PEG ratio at about the same level as the sector, which I think is just way too attractive to ignore. So even though I love Microsoft stock, at the current moment, Amazon gets the top spot. But coming in as the biggest purchase of all, that was in none other than the iPhone giant, Apple, ticker symbol AAPL, which BlackRock added another $4 billion of in the quarter, bringing their stake up to over $250 billion in total, making it also the largest holding of the five at over 5.3%. Now, for this one, I do think that it's okay. I do own Apple stock myself, by the way. However, it's just not as attractive as the others for me. Now, don't get me wrong, the company is incredibly large and profitable, doing close to $400 and $100 billion in sales and profits, respectively, which is probably worth owning just for that size and dominance alone. However, at that size, you're just not likely to get much growth from here going forward. Like last year, for example, sales only grew 2%, while net income actually declined for the second year in a row. And in future years, I really wouldn't expect much more growth than maybe like a mid-single digit rate on the top line at best, which is not great for a stock that usually trades near a record high already and carries a PEG ratio that is also close to 60% more expensive than the sector too. Again, there's nothing wrong with owning this one. I own it myself, but it's hard to rank them very high when I just know that there's so many better options out there. Like for example, Google, who not only has their own family of similar products and services in their Pixel lineup, but their Android operating system is also more than double the size of iOS. Their Chrome browser is more than triple the size of Safari, and they're way more diversified across a number of other different businesses too, like in cloud, AI, autonomous driving, and so much more. I get that Apple is stronger at what they do specifically in their family of products and services. Yeah, Apple excels. But Google as a stock is also more diversified and is much cheaper in price with a PEG ratio that is actually lower than even the sector median. So just because I'd much rather put my money into that stock instead, I'm going to have to rank Apple lower than the other three that I also just kind of like a bit more. But hey, there you have it, guys. Pretty good batch of stocks here to, worth buying, I think, for the long term. Let me know if you agree with my ranking or would you make any changes to it. I'd love to hear your thoughts on that. But I hope you enjoyed the video and I will catch you in the next one. All right, take care, my friends. Thanks for stopping by. I'll see you later. Bye-bye.